Good afternoon to all our clients, friends, and most of them, all of them, John Reade. Today we're going to talk with you, as usual, about gold. Thank you very much for your time, taking the time to talk with us for our 20 minutes coffee, John. Good to see you.
Yeah, it's good to be back, and it's great to talk to you.
Indeed. So a lot of things happening. That's the reason why talk every quarter for us. It's very important, and especially about this very important asset class like gold. It is. John, let's kick off for this 20 minutes. Otherwise, I'm pretty sure it's going to be very juicy. So let's use it the most of it. Gold in 2025 last year had been like a spectacular year, right? What, in your opinion, were the main drivers of demand, and how did they impact on the gold price?
Sure. And I think the big change we saw last year was a large increase in investment demand. Now, investment demand's been part of the strong story in gold for the past couple of years, but it increased tremendously in 2025. What we've seen is Western investors and Western speculators joining in the other strong sources of buying that we've seen over the preceding few years. It all started with central banks in 2022. We then saw very strong emerging market demand, both for investment and even from time to time from jewelry demand as well. But really, towards the end of 2024, we started to see Western investors return. And most obviously, you could see this with the flows into exchange-traded funds. And ETFs, which had been small sellers for the preceding 4 years, were large buyers last year, 800 tons of purchases, and that's a big change in what is a 5,000-ton gold market. So we went from being small sellers to buying 801 tons last year. It wasn't the only source of strong investment demand, but it's certainly the most obvious ones. And it was investment demand that joined in with those other sources of demand, which really powered gold higher in 2025.
John, and the drivers behind that, I think it's been a few of them. I'm pretty sure are in common, but we are experiencing a lot of different drivers. There is one of them, in your opinion, that is in common with all these different kind of investors, because you mentioned about Western investor, you mentioned about retail, you mentioned about the institutional player. I'm pretty sure that their drivers is pretty different one by the other one.
Yes, I mean, the common theme of all the drivers of investment demand, certainly all of the Western investment demand, has been the United States, and specifically the actions and statements from the administration of President Trump. Whether it is the tariffs, which we've seen announced, whether it's talk of interest rates being cut further, whether it's the prospects of a new Fed chair, which will be installed by President Trump in the second quarter, and what that will mean to monetary policy, but also what it means for the status of the US dollar in the treasury markets. So yes, there are individual reasons why some gold markets like China, for example, remain strong in investment demand. But the big change we saw in 2025 was a broadening of this investment demand, primarily driven by statements out of the United States.
Got it. We saw a sort of, I would say, a shift in January, last January. I used to say that it looks like a little bit wild, this shift from, of course, the 2025 big spike of pricing and everything. If we think about what happened, why and where we ended up, and what are the important things to focus on going forward, right?
Yeah, I mean, January was wild, as you say. We saw gold start the year and then just trade higher all the way through January, right up until the last few days when we got a correction. And the increase in the price hit about 30%. and then we saw a correction over the next 2 or 3 days of about 20%. So really some wild moves, and in dollar terms, the daily trading ranges of gold I've never seen before, taking place towards the end of January. Now, there's a number of factors behind that. January is often a strong month for the gold price, and we probably saw some people investing, deploying more capital into gold at the start of the month. We also had geopolitical factors going on as well, specifically the action that was taken against the so-called president of Venezuela, and the changes that took place there. And I think the final thing is as well is gold's really strong moves in 2025 has attracted more money, and it almost becomes a self-fulfilling prophecy when you see such strong gains, and then everyone's talking about gold. The man on the street, the woman on the street around the world, is hearing about gold and is actually queuing up to buy gold in all sorts of different forms, whether it's ETF demand, whether it's physical bars and coins. We saw that throughout the world. And if there's one country that I would focus on where this really manifested itself, was in China, where buying of gold and particularly silver in physical form really became a huge theme towards the tail end of 2025 and into January of 2026. So in terms of what we should take from this move in January, I suppose there's a few points. The first of all is 30% increase in the gold price in 1 month is unsustainable. We do not expect gold to perform like that, on a sequential basis. So when you see it go up so fast in such a short space of time, you shouldn't be surprised of an imminent correction. And various technical measures, technical analysis measures, certainly suggested from the start of January the gold was overheating. Admittedly, it continued to stay overheated for another month. So timing is difficult on these things, but you certainly should have been aware that a correction was possible. I think the second thing we should take away from this as well, though, is expect more volatility in 2026. And I'm not even talking about external factors like we've seen with the recent conflict in the Middle East, but even just within the gold market itself. When it's been trading positively now, as it has done for the last few years, it is on people's radar screens. It will, from time to time, attract splurges of investment demand like we've seen. And that's going to mean the price can go up and then correct more frequently. That really hasn't been a factor in most of this move that we've seen in the gold price over the last few years. It was only October 2025 that we saw the first material correction in this strong bull move in gold. But what I would say is January is indicating to us that there will be more of these going forward. And I think that's useful because having high volatility in a market gives some opportunities to investors if they want to take advantage of it. And perhaps the easiest way to take advantage of that is to wait for a correction to increase your holdings. Sometimes you don't need to chase the gold price higher. With a bit of patience, potentially, you might be able to find better levels to buy gold than at the current price, for example, should we see another correction.
Appreciate it, John. It's very clear. I thought that the geopolitical side of the angle, since we've been learning, that gold somehow is very important for defensive as a sort of edge in the portfolio. So I thought that also what's happening right now, maybe it's too early, but what's happening also right now, you mentioned the new war that we are experiencing, Israel, US, Iran, could even more create much more flow towards, but this is probably something that we're gonna see in a little while, I guess. So because you mentioned the Venezuela side, so also this one, it's a new one. But one thing that I would like actually to go on the fundamental side, when we talk about gold, also it's very important to understand supply and demand side. So what key things stood out to you from a demand and supply point of view for last year?
Yeah, it's a great question because I think the fundamentals of gold aren't necessarily appreciated by everybody that looks at the gold price. And to me, the biggest thing that surprised me, or I would say contributed to the move higher in the price last year, was actually not on the demand side. It was on the supply side. Normally, what happens when the gold price goes up rapidly is you see an increase in supply coming back to the market. And that increase in supply comes from not mine production, because mine production only responds over years, maybe decades, but it actually comes from the recycling of old jewelry. So in round numbers, about 3,600 tons of gold are mined every year, and about 1,400 tons of old jewelry scrap comes back to the market, goes through refineries, and is available to buyers of gold. Now, when you see the price increasing dramatically, like it has done over the last few years, and particularly in 2025, we would normally expect to see an enormous increase in people selling back their old and broken, unwanted jewelry. But that hasn't really taken place. So what that means is, with mine production more or less static, with recycling supply more or less static, there's no extra gold around. And that's really important because if you think about what happened last year, we saw this huge increase in investment demand for gold, but no increase in supply. So what fulfilled that investment demand? Where did that demand come from? Well, the only place it could come from really is the jewelry sector. And how did it come from the jewelry sector? Very simply, you had to push the price of gold higher to persuade people to buy less jewelry so that you could make room for this investment demand, so that they could buy the pieces of gold that they wanted to. So that to me is perhaps the biggest thing that happened last year, is that we're in a supply constrained environment with a corresponding big increase in investment demand for gold. And that's why the price went up so much last year.
Interesting. I would like to go back. At the very beginning, you mentioned a little bit the flow of purchasing of the gold. You mentioned about a Western investor very strongly. You mentioned about speculators. You mentioned about retails. But you mentioned also another very important player that is an institutional side, the central banks.
Yeah.
We saw a huge flow of purchasing by the biggest central banks in the world in the last year. I would like to ask you, what is your opinion on this? Why you think that central bank have been buying so much gold in recent years? And also, I'm pretty sure that you don't have the crystal ball magic, but also on the other side, I want to try to instigate this one. Do you think that this trend will continue?
Sure. So look, a bit of background in central banks. Remember, the gold market's about 5,000 tons in size. Now, central banks have bought gold every year since 2010. And between 2010 and 2021, they bought an average of just less than 500 tons a year. Okay. In 2022, they doubled those purchases to over 1,000 tons. And they bought over 1,000 tons in 2023 and 2024. So why did they increase their purchases? Well, I think there's a few reasons. The discussion regarding de-dollarization and moving away from one single currency, the US dollar, towards a number of important currencies, that de-dollarization argument gained force. Lots more people were talking about it, particularly after the pandemic. The second thing was, inflation is different now from the way it was prior to the pandemic. If you think about the period post-global financial crisis and up to 2021, the challenge that Western central banks had is that inflation was too low. That's not the case anymore. Inflation is a bit too high and proving to be sticky. So that changes the way a central bank thinks about its gold holdings too. Probably the most important thing, though, was the decision by Western countries to sanction Russia following the invasion of Ukraine, and the sanctioning of the Central Bank of Russia in particular, and the freezing of its assets, meant that the gold that Russia held which it held in Russia under its control, suddenly became a lot more important to both the central bank of Russia, but also other central banks as well. So there's been a reassessment, I think, about what central banks should have in their reserves, and that's benefiting gold. So those three reasons caused the big increase, we think, in what central banks have done in gold. Now, in 2025, they still bought a good amount of gold, something like 853 tons of gold in 2025. But that's lower than we saw in 2022, 2023, and 2024. And I believe that it's the price increase that has resulted in less purchases from central banks. Now, why do I say that? Well, imagine you're a central bank that's been planning to increase its gold holdings and you want to have, let's say, 20% of your reserves in gold. And you've been buying gold. So that's been increasing the percentage of reserves in gold. But the gold price then goes up by 67%. That has an enormous increase in the proportion that gold makes up of your foreign exchange reserves. So the move in the gold price alone has done a lot of the heavy lifting of central banks that have wanted to increase their purchases in gold. And I think that may be causing some of them to slow down what they're buying. We've even seen sales from a couple of central banks, which I suspect are rebalancing transactions. So in other words, a central bank like the Monetary Authority of Singapore, which bought gold a few years ago, and I was quite excited when I saw that because I thought it might be the start of a major buying program from what is a central bank with hundreds of billions of dollars of reserves. They allocated between 4 and 5% of their reserves to gold, but they didn't buy any more. And in fact, they actually started to reduce their holdings in 2024 and did so more in 2025. Now, they don't tell us what they're thinking. There's been no public pronouncements from the Monetary Authority of Singapore about what their intentions are. But I suspect what they did is they made an explicit allocation to gold in percentage terms, and then the gold price went up a lot. So what they're doing is they're just rebalancing and they're reducing their gold holdings to take it back to the target weighting that they plan to do. So I think that's probably a good description. Those two cases are a good description of why central banks have bought a little bit less gold last year than they had in previous years. And it's mostly to do with the price. Now, you're right, I don't have a crystal ball. But what I do have is the benefit of surveys that we do of central banks every year. And those surveys are going out right now. We'll get the results back just after Easter, and we'll publish them in a document in May and June. Now, every time we've conducted this survey, we've seen a growing expectation of the central bank community for further buying. And we've seen a growing number of central banks say that they're planning to add gold to their reserves. Now, the last survey we've got was also done around Easter last year, but the gold price was about $3,000 an ounce at that time. Now we're trading at about $5,000 an ounce, and it'll be very interesting to see what the central banks say in terms of their intentions. I think there is a chance that some of them will say that they're not planning to add gold to their holdings after the moves that we've seen in the gold price over the last 12 months. We are confident that central bank buying will continue, and we do think that the purchase levels will be at this new higher range than we saw prior to 2022. But I don't think we'll see 1,000 tons of purchases by central banks if the gold price is at current levels.
And we are very lucky to have this collaboration with you guys, because also we're gonna use all your knowledge either in London in April, where we're going to do our new launch seminar, and then later in September in Zurich, where we are going to receive fresh juice from you regarding the survey and so on. But let's close it we have another 30 seconds. You mentioned about this big spread of price between the 3,000 that you mentioned a few years ago and now 5,000. Do you think that there still continue to be a strategic case for gold still valid for the $5,000 for ounces?
I do, and I'll tell you why. And it's not actually very much to do with central bank buying. It's not very much to do with supply. It's to do with portfolio construction. One of the things that we have heard from many investors, but also from large banks, is that They're looking to add gold to their portfolios because the diversification benefits of bonds, government bonds, are not as reliable as they used to be. Now, at the moment, average investment holdings across all portfolios around the world of gold works out at about 3% of their assets under management. Most of the work that we've done in the past suggests that a weighting of between 5 and 10% is appropriate for most portfolios. But if we're going to get to a situation where bonds are going to be less useful as a diversifier and government deficits are so wide that there's going to be much more supply, you can make a credible argument, as Morgan Stanley did, that perhaps the right number for gold in your portfolio going forward is 20%. Now, if we're not expecting the world to go to 20% in gold, but any moves that increase the proportion that gold is of portfolios up towards initially the 5%, then potentially the 10%, and finally towards 20%, that could see gold being bought by investors in very large quantities for years, if not decades to come. That's why I think the strategic case for gold still makes sense, is diversification properties alone make it justify its inclusion in portfolios. And when you look at its long-term returns, never mind the short-term returns, but the long-term returns that we've seen, it's a good contributor to performance as well.
And this is something that we are going to continue to assess together in the coming quarter and month. John, thank you very much for your time. I really appreciate once again having you on the 20 Minutes Coffee, and we're going to talk very soon. Thank you.
Fantastic. Thank you very much, Antonio.